We always think about it as innovation above and beyond a base case real estate return. As we build out our real estate themes, we're simultaneously meeting with CEOs of innovative companies and saying, hey, what's going on? What are you doing that could augment what we're doing? And if you structure that right, you can really create the American dream for your renters. Yeah, so everything we do starts with the same process, which is...
Dan, such a pleasure to have you here.
Nice to see you.
Absolutely. So for me, I had the pleasure of working with you while you were a principal at Ares, a fund of over $300 billion. And now I'm super excited that you're doing your own thing. So let's talk about that.
Yeah, thanks, man. And look, it's been a wild ride, but really nice to be here, and nice to always work with Arcadia. You guys are amazing. So good to see everything you're doing.
Yeah. So talk to me. I guess you were at Ares, obviously, for over a decade.
Yeah. So I was at Ares for 10 years. I love opportunistic investing. Saw the business grow from when I joined, it was about $5 billion of AUM in real estate to over 55 last year. But in late 2022, I was sitting with some of my friends, prior associates actually from when I was in banking at JP Morgan, and we were saying, look, the real estate markets have flattened. There's a total disconnect between underlying real estate fundamentals. Some markets are doing really well, and capital markets, which are fragmented. Yeah. So it creates a great opportunity for a vintage real estate investing platform. Mm-hmm. And so we set out to create a business. And we set out really in the inverse of most people. We said, let's create an institutional platform first, mm-hmm. and then attack trends that we see in the market and we see in this vintage.
Could we talk about some of those trends? And I think, first and foremost, given your experience in the business, you've just known these institutional investors for so long that I'm assuming now you're sort of leveraging those relationships. But what are you guys doing differently as it relates to the investment trends that you see today?
Yeah, so the first thing we do from the investment thesis and sort of setting out our target markets and what we want to do is the same kind of white paper process that we would use at a large asset manager. But before we even get to that, we really needed to build a team, and we needed to build a business strategy, and we needed to capitalize it. So we came together with myself, my partner, Peter Weiss, and a couple other partners that we had known for a long time. And we set up a really interesting platform. And that's, I think, the real differentiator is not that, we were great investors at a large shop and now we're doing it on our own, but really we set up an interesting platform. So today, Alpaca Real Estate has two verticals. One vertical is very typical opportunistic real estate fund. Mm-hmm. And the vertical we sit next to is a venture capital fund that's invested about $200 million in over 100 companies. And so what that gives us is a really interesting edge into what's going on in innovation. And then we bring it back and think, how can we apply this to our underlying real estate investments?
Are you starting both of the VC and the real estate fund simultaneously now? Is something you're kickstarting?
So the VC fund's actually been around for about 10 years. Oh, so wow. That actually enabled us to leverage a lot of internal resources. And mm-hmm. Running an institutional quality investment management business takes a lot of resources. Yeah. So today we've got about 20 investment professionals, or 20 professionals, 5 investment professionals, and 15 in the back office and mid office. So there's a lot of compliance, accounting, et cetera, to get up and running.
It's not easy to put all the pieces together. So as it relates to Alpaca Real Estate, do you guys have a theme as it relates to markets, asset class? Talk to us about that.
Yeah, so everything we do starts with the same process, which is we try to identify a durable demand driver that we think is going to be present for our investment period. Mm-hmm. So our investment period is 3 years. We say, okay, what's going on in the economy, what's going on in the country that we think probably isn't going to change, mm-hmm. and that we can find ways to invest through. Mm-hmm. So the two themes that we really like, one, the fact that single family homes are by and large not affordable for the average American. Yeah. And there's a lot of ways to attack that. Right. One thing we really like to do is buying from regional home builders or building tracts of single family housing, mm-hmm. purposefully for rent. Mm-hmm. So effectively creating rental product for families that otherwise wouldn't be able to afford their mortgage in a traditional sense if they were to go out and buy that home. So that's a theme that we don't see changing, where one, interest rates are extremely high, but even if they come down a little bit, home prices are still prohibitively expensive for a lot of families. So that's one area we like a lot. And another area we like is infill industrial distribution. sort of last mile industrial, and the reason is I'll call it last 10 mile. And there again, I've got 3 small kids. My oldest is 5, and so we have so many Amazon packages and packages from other places showing up, and I'm not unique, right? There's a lot of people who are seeing just packages pile up, and so that creates a lot of demand from e-commerce distribution services. So one thing we can do is sort of fly under the radar of the larger bulk warehouse distribution that are sort of 1 million plus square feet, and instead buy or build product in the 100 to 300,000 foot range that's a lot closer into a population center.
Very interesting.
Residential and industrial, but really subsects of each one where we think there's some dislocation.
Yeah, and I mean, in Miami's particularly, you're like preaching to the choir where it's very, very hard to afford a home. I mean, they're in the $3, $4, $5 million range for primary markets. But to your point, like that's happening in more acute ways across the country. It's not just Miami.
Yeah, and Miami is a great example actually because a project I worked on a couple of years ago, we built apartments and townhomes right next to each other. It was in Davie, right behind Fort Lauderdale. Mm-hmm. And at the time we were leasing it up for a 3-bedroom apartment and a 3-bedroom townhome. You get the same rent. People would not pay more to be in a townhome. Now, to be in a townhome where you have more space,
oh my God,
there's noise attenuation, you have a little private backyard, it's $1,000 more per month.
Yeah.
And so that kind of demand shift and the fact that people want to be in homes, but for them at this instant, maybe they can't afford it, is a great opportunity.
Yeah, we worked on a project called Manor at Broken Sound that we were like using as a comp on one of our deals in Boca. Yeah. And same thing, the townhomes were like $8,000 a month, and the 3 bedrooms in
a lot, yeah.
It's crazy.
Yeah.
The 3 bedrooms inside the building were like 5,000, maybe 6,000. But to your point, interestingly enough, when I went to go tour the asset and talk to the leasing agents, they said it's a lot of people looking to buy $3+ million homes, but they're just waiting for the right home or the right time. So talk to me if you have any opinions on, where we are as a capital market or not necessarily like guessing interest rates, but where we are sort of in the macro environment right now.
Yeah, look, it's still pretty static. Last year investment volume was down 70%. Yeah. And so a big thing that I was worried about coming out of a huge shop was, is there going to be deal volume? Are there going to be opportunities? Right now, I think is prime time for opportunities, right? There are a lot of deals that aren't getting done, and there's a lot of recapitalizations of assets that still need to kick through for the next 12 to 18 months. Right. So, we don't have any forecast of interest rates declining immediately and then capital markets becoming frothy again. We think it's going to be a hard road to toe for the next 12 to 18 months. So that creates a lot of opportunity for people who want to recognize a new basis in fundamentally good assets.
And I think it makes a particularly opportune time for well-capitalized groups. So talk to me, I mean, you guys are looking, I guess, for pension funds first to sort of raise a fund. How's the sentiment when you're going to these big institutional investors? Are they sort of still waiting and seeing? Are they like, yes, talk to me, here's my money?
Yeah, definitely not that. It's really, I mean, I think everyone I talk to, they say, look, it's always been hard and now it's even harder. And so what we were really lucky enough was to have a couple of very close relationships support us early on. And so, we've now, and it's public, we were able to see our fund with 6 pensions that were advised by a large asset manager in New York called GCM Grosvenor. And that enabled us to go through pension diligence up front.
Right.
And so, that's a very, very hard process to go through.
Could imagine.
But we were able to go through that and then launch with a great anchor and a great partner to help us grow the business. And so now we're out, looking at deals. We sort of recognize that initial closing. We're looking at things to do. There's plenty of opportunity, so it's exciting. And then, like you said, fundraising is a long process, so we'll be out, as we start to seed the fund with assets, accepting new investors.
So do you guys, and just for my edification, do you guys then fundraise for 6 months, 2 years, whatever it is, close the fund, and then start looking for assets?
No, we look right now.
Okay.
And so the way it works actually is that we already announced our first closing in the fourth quarter. Mm-hmm. And so that enables us to get out with capital available and look for deals today. So we actually had a couple of things we were looking at over the summer. We decided to drop them when there was all the volatility in treasuries. We said, look, we think that prices are probably going down a little bit more, and there's no sense to rush into everything. So we today have an entirely blank pool. We've got great things in the pipeline, but we've been really metered about our deployment pace.
Right, but all the while still raising more money that then ends up getting closed. Like this will be fund one at a certain price point,
you basically the fund. The way it works, the fund's in market for a certain period of time. You add deals to that fund over the period of time.
Got it. And then from a geographical perspective, are there places where you're saying, hey, we like, Florida or this more than Seattle or California, or is it like more the asset classes where we see the theme nationally?
Yeah, no, it's both. So the way we do any investment is we start with a macro thesis. We write a white paper on it. The conclusion of the white paper is a target market, so where we would want to attack that trend, and then a buy box of what exactly it looks like we would want to invest in. Finally, a go-to-market strategy of are you going to do a preferred equity deal, a recapitalization, a direct acquisition, originate a mortgage, do a development, what's it going to look like to get access to the product, and then finally a pipeline of can I find what I'm talking about finding. And so for each concentration or focus, it's different. For single family homes or build to rent communities, really focused on high growth markets. So Texas is, I think, number one right now. Florida was number one, but insurance in Florida has made it really difficult to underwrite in a conservative way. You can just look at trends over insurance and try to forecast, but it's really, really difficult. So I think Florida was probably number one, is probably notched down to number two. We're otherwise interested in the Southeast for that strategy. And then on the industrial side, those markets work, but also large population centers work. So for example, New York City is 7% of the US GDP. There's a lot of packages, a lot of population. And if you can secure a distribution footprint that's within 30 minutes of the city, you'll probably have a lot of demand from a tenant base for that. So depending on asset type, our geographic focus shifts a little bit.
Yeah, I'm curious. So as you were making this transition, right, what are things that you think you sort of like underestimated as you're like putting together, Alpaca and doing these things?
What did we underestimate? How much time there is in the day. I think that's really what it is. I think in any entrepreneurial journey, there's so many things you can do, and it's just figuring out which ones are priorities. So that's I think one thing that we are cognizant of, and the other is the value of trust and partnership. We came together with a really good group, and the foundation of the whole company is that the partners really trust each other and rely on one another, right? Because of what I was just talking about, there's not enough time in the day. That means you can't do everything yourself. You need to have a lot of faith in the people that you're working with, that they're gonna, throw the javelin just as far as you would.
No, I mean, in our relationship, having worked together in the past as well, it's like, Omar, do you have comps for this? Do you have data for that? And I remember just going back and forth a lot, like, we just need help in gathering this type of data, and you're the market expert, like, help us out there. And I'm like, absolutely. And it was, in retrospect, I was like, what are you seeing on your side, right? Because you're talking to all these institutions, and we want a lens into what you guys are thinking, which is, the relationship's been very helpful over the years. So from an innovation standpoint, which I think is something you guys are doing unique, you've got Alpaca VC, right? Are there, I guess, like products that you guys are investing in there? I don't know if it's prop tech that either gives you trends to look forward to or gives you ways to get, better margins on existing products, or is it no overlap?
So the way you think about it, Alpaca VC is invested in about 100 companies. They put about $200 million in across 4 funds. So these are smaller investments that give them a wide purview into really seed and early stage companies. So there's a lot of innovation. Many of those companies are in the real estate space. And so they then allow us to say, hey, is this application of technology or innovation applicable to what we're doing? So for each of the 100 companies that they've invested in, they probably met with 15, right? Because that's usually what you do. You look at 15 options, you pick one. So they've got this fantastic network of thought leadership, put out a lot of research, and that enables us to really have connectivity, not to one innovative CEO, but to hundreds. And so as we build out our real estate themes, we're simultaneously meeting with CEOs of innovative companies and saying, hey, what's going on? What are you doing that could augment what we're doing? We always think about it as innovation above and beyond a base case real estate return. So we underwrite every deal to our target IRR, which today is 20 to 22%. And then we say, what additional alpha can innovation add? So it's always alpha from innovation above a base case real estate return.
Got it.
And then people say, okay, great. Well, what are examples? What works? What doesn't work?
Yeah.
The portfolio Alpaca VC is on the website, so it's public. There are some things that don't work today, like 3D printing homes for rent. Right now, the cost to 3D print a home is too expensive, so it doesn't work. Right? We can do it cheaper just using typical or traditional construction methodologies. Some things do work really well, though. Like one thing we like in the rental space on single-family homes is a program called Rent to Own, whereby you enable the renter to have an option to buy their house at some point in the future.
Okay.
And if you structure that right, you can really create the American dream for your renters, right? They know what it's going to cost them to buy the house. You can implement other programs like credit enhancement programs, forced savings accounts, things like that to make it easier for them to actually buy in the future. There are a couple of companies that have programs that do this. And so we've been in contact with now, I think 15 of them, figuring out the best way to lay that over on top of to traditional build-to-rent community. So that's on the residential side. Another thing we really like on the residential side is some type of corporate short-term rental program. And we think there's a lot of room in the short-term rental space, especially within multifamily buildings. Something that I've done before is take a couple floors of a multifamily building, have it all operated by one professional manager, and then you let it out really to more of a longer-term corporate tenant, but not somebody who's necessarily just coming for a 1 or 2 day stay. And then on the industrial side, one thing that we are really focused on is sort of small bay warehousing, whereby we buy industrial assets that have vacancy already. So say a 70% leased asset, we take the 30% vacancy and we bring in an operator to manage it, but manage it to smaller individual tenants. That allows us to lease up the asset effectively overnight, and then the operator creates all these subleases that end up boosting rent at the end of the day.
Got it. Yeah, I mean, similar to short-term multifamily almost, right? The mechanism there. Yeah, I remember we worked on a deal where it was, 100% multifamily rentals. The buyer ended up doing like a mix of that and like 50% furnished short-term rentals. And what amazed me, like obviously it has to be the right market in the right way. It creates some more turnover and repairs and maintenance, but the NOI on these short-term rentals was just mind-blowing relative to the 12-month leases.
It's huge. I worked on a project that was in sort of Jersey City, so right next to Manhattan, about one train station away from downtown Manhattan, where all the big banks have their headquarters. And the short-term rental clients were all banks.
Yeah.
And they would come, a banker would come in for 3 weeks or 2 months, and they would need a place to stay. And the rent was great. They weren't that hard on the units, but you would have a little additional R&M.
Right.
And so it was easy math.
Yeah.
And then finally, like when we push further out on the spectrum, I think the most innovative thing that we see today is that at Alpaca VC, they've invested in 2 electric vehicle charging companies.
Okay.
And so on the residential side, we actually don't see much of an opportunity, but it's really interesting when we look at the industrial side, where we can bring more power to an individual warehouse and allow a tenant to charge 25 or 50 delivery trucks all at one time. That's a differentiator that's pretty difficult. So we're working pretty heavily with one of the portfolio companies in that way.
That's incredible. No, I'm super excited with what you're doing. Now, take me a little back, because I've been a huge fan of yours since I met you years ago. You're extremely smart, responsive, poised. And I think a lot of people listening to this are looking at you as a principal of a $400 billion fund at one point and now doing your own thing. I guess talk to me of how'd you get started into real estate? What was your first sort of gig? And then maybe at Ares, what helped you get to the point where you were a principal at one of the largest asset managers in the world?
I grew up in Brooklyn, New York, and so Brooklyn was changing really significantly while I grew up there, which got me interested in real estate. Still own my family's house that grew up in. And the first thing I did when I was 16, I worked at an architecture firm. I said, I love architecture, but I'm probably not going to be an architect. So I thought I wanted to be a developer. So then all throughout college, worked at a brokerage company. Was my first thing. The day I was 18 years old, I got my real estate salesperson's license. Did that for a summer. Worked at a subprime mortgage securitization fund for a summer. Then started doing affordable housing development with Habitat for Humanity, actually, in New York City. They were the only people that would let me close to a building. And then finally, for the last couple of years of college, worked at a developer. And then development is great, but it's really focused on one city. And that city can go out of vogue, or maybe the product type that you're expert in, there's an issue with. For example, New York City condos in 2010 wasn't a great place to be investing. So then I went to banking. I did banking at JP Morgan for a couple of years, which is where I met my business partner. And there we said, look, we really want to do opportunistic real estate investing, which is based in first defining a thesis and then going in and attacking that thesis in whatever market, in whatever way it makes the most sense. So then out of JP Morgan, recruited into what is now Ares. It was at the time Area Property Partners, which was founded and run by some really successful real estate pros of the last generation. And at Ares, it was a great growth journey, right? You learn sort of how to do first-class business in a first-class way, tell people what you're going to do and then do it, and have fun while you're at it. So, was there for 10 years, covering a bunch of different sectors, securities, equities, and ultimately, at the end of 10 years, we looked down at 2022 and we said, this is the time if we're going to do it on our own to go do it.
Yeah, no, I think the capital market environment where it is today, where it's been in the last 18 months, is going to lead to a ton of opportunities that I'm excited that you're going to be taking advantage of.
Yeah, thanks. Well, hopefully we do some of that together.
Absolutely. Thank you, Dan.
Cool. Thank you.